Jake puts $50,000 into a rental property. Marcus puts the same $50,000 into the stock market. They both think they made the smarter choice. They're both wrong because neither of them ran the numbers past year one. And when you actually do, the gap between them is bigger than either of them expected. Let's keep this fair. Jake and Marcus both earn $55,000 a year. They both have $50,000 saved. Same age, same city, same starting point. The only difference is what they do with that money on a single afternoon in March. Jake drives to a real estate agent's office. Marcus opens a brokerage account on his phone. Jake uses his $50,000 as a 20% down payment on a $250,000 rental property. 3-bedroom house, decent neighborhood, good school district. He takes out a 30-year mortgage at 7% interest. His monthly mortgage payment is $1,330. He finds a tenant willing to pay $1,800 a month. That's $470 in profit before he spends a single dollar on anything else. Jake calls his brother that night and tells him he's a real estate investor now. Marcus puts his $50,000 into a total market index fund, sets up a $300 automatic monthly contribution, closes the app. His co-workers ask him what he invested in. He says index funds. They nod and change the subject. Nobody's impressed. There's no story to tell. There's no key in his pocket. There's just a confirmation email and a number on a screen. On day one, Jake is winning every conversation. Marcus is winning nothing. But conversations and math are two completely different things. For the first 2 years, Jake is living exactly what he imagined. Rent hits his account on the first of every month. He drives past the property on his way to work and thinks about equity. He's deducting mortgage interest on his taxes. He's watching comparable homes tick up in value. Every part of this investment feels real and solid and smart. Marcus logs into his brokerage account once a month, sees the number go up slightly, then down slightly, then up a little more. Year one, his $50,000 becomes around $55,000. Year two, maybe $61,000. Nothing about it feels like anything. No key, no tenant, no asset he can point to from a car window. Jake's friends ask him about the property at every gathering. Marcus doesn't get asked about anything. Now let's look at what's actually happening inside the numbers. Jake has collected $43,200 in rent over 2 years. His mortgage payments total $31,920. That leaves $11,280 in gross cash flow. Sounds like a real business. Then you start subtracting everything the rent check doesn't mention. Property taxes, around $3,000 a year. Insurance, another $1,500 a year. In month 8, the water heater dies. $1,100 to replace. In month 19, the tenant reports a leak in the roof. $2,400 to fix. 1 month between tenants. $1,800 in lost rent. $500 to clean and relist. Jake handles everything himself to save money. That means phone calls after dinner, weekends driving across town, and coordinating contractors on his lunch break. After everything real, Jake's actual net cash flow over 2 years is somewhere between $1,500 and $3,000, not $11,280, not even close. Marcus has contributed $50,000 upfront, plus $7,200 in monthly additions. At roughly 10% average annual return, his portfolio is sitting around $68,000 to $72,000. He spent 0 hours managing it, 0 phone calls, zero emergency repairs. But here's the part that keeps Jake in the conversation. Leverage. Jake used $50,000 to control a $250,000 asset. Marcus used $50,000 to control $50,000 in assets. That 5-to-1 ratio is the single most powerful advantage real estate has over the stock market, and it cannot be ignored. Jake's property has appreciated roughly 3% a year and is now worth around $265,000. His equity has grown to about $60,000. That wealth didn't come from his savings. It came from the bank's money working alongside his. That's why real estate investors sound so confident, because for the first few years, they should be. By year 5, the picture starts shifting. Jake is on his third tenant. He replaced the roof for $8,500, dealt with a plumbing emergency for $1,200, had 6 weeks of vacancy between tenants. He's raised rent to $1,950, which helps, but property taxes and insurance have climbed too. His actual cash-on-cash return, after all real expenses, is hovering around 4%. Not the 15 or 20% he mentioned at the barbecue. He also hasn't had a free Saturday in 2 years. Marcus's portfolio has grown to roughly $130,000 to $145,000, including his monthly contributions. He didn't pick stocks, he didn't time the market, he didn't do anything except leave it alone. The compounding is starting to accelerate now. The returns on his returns are generating more new wealth each year than his original contributions ever did. This is the part that changes everything, and most people never stay patient long enough to see it. By year 10, Jake's property is worth around $335,000. His remaining mortgage balance is about $180,000. His equity sits at roughly $155,000. That's real wealth, built partly on borrowed money, built partly on appreciation, built partly on a decade of midnight phone calls and weekend repairs. Marcus's portfolio is sitting at approximately $160,000 to $175,000 with consistent contributions and historical market returns. He put in $86,000 total. The rest is compounding, doing what compounding does when you leave it alone long enough. At year 10, they are remarkably close in total wealth. Jake might be slightly ahead because of leverage, but Jake also spent hundreds of hours managing a single asset in a single zip code while taking on $200,000 in debt. Marcus diversified across thousands of companies and never lost a night of sleep. The scoreboard looks tied. The experience getting there was completely different. Now watch what happens in the second decade. Compounding doesn't grow in a straight line. It grows in a curve. The first 10 years build the base. The second 10 years is where the curve bends sharply upward. Every dollar Marcus has invested is now generating returns on returns on returns. His portfolio between year 10 and year 20 doesn't just grow. It accelerates. By year 20, Marcus's portfolio is sitting at approximately $430,000 to $470,000. Total contributions of $122,000 over 20 years. The other $300,000 plus is pure compounding. No debt, no tenants, no renovation budgets, no eviction risk, just time, doing what time does, to money left alone. Jake's property is worth somewhere between $450,000 and $500,000. His mortgage is paid off or nearly there. His equity is significant, but after 20 years of maintenance, repairs, turnovers, taxes, insurance, capital expenditures, and at least one major renovation, his net cash flow profit above all expenses might land between $50,000 and $90,000. When you net everything out, they arrive at roughly the same destination. But Marcus took a completely different road to get there. Now here's what people who only watch real estate channels won't tell you. The stock market has real risks. The 2008 crash wiped 37% off portfolios. March 2020 dropped 34% in weeks. If Marcus had $150,000 and watched it fall to $95,000 on a Tuesday morning, that's not a number on a screen anymore. That's gut-wrenching. And most retail investors panic sell at the bottom and buy back in after the recovery, locking in losses at exactly the wrong moment. There's no cash flow. Index funds don't send you a monthly check you can spend. Dividends on a total market fund run about 1.5 to 2% annually. On $150,000, that's maybe $200 a month. That's not replacing anyone's income. And there's no leverage. Marcus used $50,000 to control $50,000. That's it. No multiplication, no bank amplifying his position. Real estate wins in specific situations that are very real and very identifiable. If you're in a market where monthly rent hits at least 0.8 to 1% of the purchase price, the cash flow math genuinely works. If you treat it as a business, not a side hustle, with proper tenant screening, capital expenditure reserves, and documented systems, the returns can exceed the stock market, especially with leverage compounding over time. If you use house hacking, living in one unit and renting the others, you can reduce your own housing cost to near zero while building equity. The stock market cannot do that. And if you understand 1031 exchanges, rolling profits from one property into the next while deferring capital gains taxes, you can build a real estate portfolio in ways that leave index fund investors behind. Real estate isn't a bad investment. It's a misunderstood one. The honest answer is this. Over 20 years, both paths can build serious wealth. The stock market wins on simplicity, liquidity, and time freedom. Real estate wins on leverage, cash flow potential, and tax advantages. Neither wins unconditionally. Both win conditionally. Jake and Marcus both made reasonable choices. What neither of them did was sit down and map out what their choice actually costs in dollars, in hours, in stress, and in risk over a full 20-year timeline before they made it. The real mistake isn't choosing real estate. The real mistake isn't choosing stocks. The real mistake is choosing either one based on a headline, a success story at a dinner party, or something that sounded smart without ever asking, what does this actually look like for me over 20 years? Because the number that includes everything is the only number that matters. And if you're wondering what happens when you do both at the same time, owning property and investing in the market simultaneously, the math changes again. And it might change everything you think you already know.